Federal Reserve officials are discussing possible policy changes to complement and enhance the president's economic reforms. One America's Kristian Rouz has our report.
Policy debate intensifies at the U.S. central bank as bond market turmoil is pointing to a possible slowdown in private sector investment, bearing a threat of full-blown recession ahead. 10-year Treasury bonds fell yet again this week, with the 10-year yield rising extremely close to a psychological threshold of 3%, as investors are expecting the central bank to aggressively increase base interest rates this year.
We were anticipating 3 hikes through the course of calendar year 2018, and we see no reason to change that. But having said that, there were many in the market who had been looking for a little more aggressive response from the Fed. And so those expectations are being moderated slightly, and I think the data is consistent with that.
This comes after Cleveland Fed President Loretta Mester touted a strong economy and President Trump's fiscal stimulus as the main reason for the central bank to pursue steeper interest rate hikes. Mester argued the economy might overheat as US GDP is poised to overshoot 3% annual growth this year amid the slightly overpriced real estate and stock assets. In such an environment, Mester said, the Trump administration's commitment to further deregulation and possibly a second round of tax cuts could give too much of a good thing to the economy, and the Fed's job is to prevent the possible risks.
The data informs our outlook, and the outlook then informs what we think of as appropriate monetary policy. So we are out in front, but we're taking on board current data because it's going to tell us something about whether we need to change our outlook or whether our outlook is on track or not.
Mester's hawkish remarks further dampened the so-called yield curve, the main indicator of future investment into the non-financial sector as opposed to safe haven investment. In response, President of Federal Reserve Bank of St. Louis, James Bullard, urged his fellow policymakers to avoid aggressive rate hikes. Bullard's comments fall in line with a more pragmatic approach to monetary policy aimed at maintaining a data-dependent approach, with the Fed reacting to macroeconomic events rather than relying on forward-looking projections.
We're late in the expansion, so I think the natural thing to forecast is that you would slow down from here. But then you've got this tax effect coming on, so maybe you'll get a little bit from that.
A GDP acceleration under the so-called Trumponomics has encouraged Fed policy hawks such as Mester, who said the Fed can't risk maintaining the still accommodative policy, which is conflicting with President Trump's fiscal stimulus and deregulation. Additionally, One American News reported previously the Fed could employ experimental policies in the future, including price level targeting and nominal income targeting, as replacing inflation and GDP measures. Mester didn't rule out such measures are indeed under consideration.
My personal belief is that, inflation targeting has served the FOMC well, but I do think we owe it to ourselves and to the public to look at these alternative frameworks and see whether there's something we can learn from them and perhaps amend our framework to make it more effective.
Mester urged base interest rates close to the so-called neutral rate, currently estimated by the Fed at some 2.9%. She also suggested further reductions of Fed holdings of the US government debt could help contain the risks of overheating the economy or an increase in financial sector imbalances. The latter includes the ongoing rise in US household debt, which has surpassed a stunning $13 trillion last year and has increased some 14% since 2013, not least due to the low interest rates policy under the Obama administration.
If we see an inversion in the US curve, which we've been talking about for ages with this 2-10 story, then I think we'll be pointing to real problems down the road. But for now, we're at least a couple of years away from really running into big problems for the economy.
In the coming weeks, Fed officials are expected to explain the alarming bond market signals, as well as provide more clarity on further policy course. Meantime, market participants are still expecting 3 or 4 interest rate hikes this year. The soonest might happen at a central bank policy meeting on June the 12th and 13th. Kristian Rouz, One American News.
We can use your help. Call your cable provider and kindly demand that One American News is added to your lineup. Call today.